Profit is important, but cash flow is what keeps your business alive. Many profitable companies go bankrupt because they run out of cash. Cash flow management is about tracking when money comes in and when it goes out, ensuring you have enough on hand to cover operating costs, salaries, taxes, and investments. For small and growing businesses, effective cash flow management improves financial stability, reduces borrowing needs, and positions the company for growth opportunities. It's one of the top indicators of business health and investor confidence. Create a cash flow forecast. One of the most powerful tools you can use is a cash flow forecast. This projection shows how much cash you expect to receive and spend over a given period, typically 13 weeks. Start by listing your expected incoming cash, customer payments, loans, grants, and all outflows, rent, payroll, inventory, marketing. Update the forecast weekly and compare actual performance versus projected. This helps identify shortfalls early and make informed decisions, like delaying purchases or accelerating collections. Tools like Excel, QuickBooks, or Float can automate and visualize forecasts, making them easier to manage. Accelerate receivables and control payables. Speeding up collections and strategically managing payments is key. Send invoices immediately after a sale or service. Offer early payment discounts or request deposits upfront. Follow up on late payments consistently and professionally. Negotiate longer payment terms with suppliers when possible. Schedule payments closer to due dates to retain cash longer. The goal is to shrink the gap between when you earn revenue and when you receive the money, while stretching out when you have to pay. Build a cash reserve and use financing wisely. Every business should build a cash cushion, ideally covering 2 to 3 months of operating expenses. This buffer protects against slow seasons, late payments, or emergencies. When financing is needed, use tools like business lines of credit, flexible access to cash, invoice factoring, sell unpaid invoices for quick liquidity, short-term loans to bridge specific gaps in working capital. Financing should support operations, not cover recurring losses. Always compare terms and fees before borrowing. Monitor key cash flow metrics. In addition to your forecast, track these key metrics: operating cash flow, OCF, net cash generated from daily operations, days sales outstanding, DSO, how quickly customers pay, current ratio, assets versus liabilities, should be 1.5 or higher, burn rate for startups, how fast you're spending cash each month. Tracking these regularly helps you spot issues early and make strategic changes before problems escalate. Conclusion. Plus, expert tips. Good cash flow management turns chaos into clarity. It helps businesses stay agile, avoid debt traps, and capitalize on growth. Make it a weekly priority, not just something you look at during tax season. 3 smart tips for stronger cash flow. Forecast weekly and adjust based on trends. Collect payments faster and delay non-urgent expenses. Keep at least 2 to 3 months of expenses in cash reserves